On January 1st, 2026, China sealed its borders to silver exports. Venezuela quietly doubled its physical acquisitions. And yet, the price collapsed. Not rose, collapsed. In every economics textbook ever written, when supply vanishes, prices explode. But this time, someone rewrote the rules. Major bullion banks dumped 47,000 paper contracts in 90 seconds during a holiday weekend when Asian buyers were asleep. The question isn't why the price fell. The question is, who knew it would, and what are they preparing for that you don't see coming? Welcome to Currency Insights, a space where we don't follow the headlines. We follow the money. If you've reached a point in life where mainstream financial news feels incomplete, where the official explanations don't quite add up anymore, then you're in the right place. I'd like to ask you something. The way one colleague asks another over coffee, would you consider subscribing to this channel? Not for entertainment, but because the next 20 minutes might change how you see the markets you thought you understood. And one more thing, drop a comment below telling us where you're watching from. Are you in North America, Europe, Asia, Latin America? Because what's happening in the silver market isn't happening in isolation. It's happening in your economy too. You just haven't connected the dots yet. Now, let's begin. On the morning of January 3rd, 2026, a trader in Singapore opened his screen and saw something that should not exist in any rational market. Silver had crashed, not declined, not corrected, crashed, down nearly $4 in a single trading session, while the world's largest silver exporter had just banned all outbound shipments. He stared at the screen, refreshed the page, checked the news feeds again. China's export ban was real, effective January 1st. Venezuela's central bank had confirmed increased physical purchases. Industrial demand projections showed tightening supply, and yet the price moved in the opposite direction. This was not supposed to happen. In every corner of the global economy, when supply disappears, prices rise. It is gravity, it is mathematics, it is law. But here, on this January morning, the law had been suspended. The Singapore trader was not alone in his confusion. In London, a fund manager reviewed his silver positions with growing unease. He had modeled every scenario: recession, currency collapse, industrial slowdown. But nowhere in his analysis had he predicted this: a supply shock, followed by a price crash. His risk models flagged the discrepancy immediately. The physical market told one story. Delivery premiums in Shanghai had jumped to 17% over spot price. Dealers in Mumbai were quoting 6-week delays on bullion orders. Refineries in Switzerland reported allocation constraints. Every indicator in the physical world screamed shortage. But the paper market, the futures exchanges, the price discovery mechanism, they broadcast abundance. Someone, somewhere, was selling silver that did not exist. The mechanics were simple enough to understand. Futures contracts, paper promises to deliver metal at a future date, can be created instantly with a few keystrokes. No mine required, no refinery, no vault. Just a computer terminal and sufficient margin capital. On January 3rd, during a holiday weekend, when liquidity was thin and buyers were scarce, someone had unleashed 47,000 contracts onto the COMEX exchange in less than 2 minutes. At current prices, that represented over 200 million ounces of silver, more than 3 months of total global mine production, dumped into the market in 90 seconds. The price responded as designed. It collapsed vertically, triggering thousands of automatic stop-loss orders. Retail traders, who had bought the breakout above $28, watched their positions liquidate automatically. Their computers sold. They had no choice. The system was designed this way, and who stood on the other side, buying those liquidated contracts? The same banks that had sold the initial 47,000. They created the crash, then profited from it. But this pattern was not new. In 2016, Deutsche Bank settled charges for precious metals manipulation. In 2018, HSBC paid fines for similar conduct. The playbook was documented, legal precedents established. And yet, here it was again, bigger, bolder, more obvious. The difference this time was context. China's export ban was not a rumor. It was policy. Venezuela's accumulation was not speculation. It was documented. The industrial supply deficit was not forecast. It was current reality. And still, the price fell. This created a question that serious analysts could not ignore. If the paper market no longer responds to physical fundamentals, then what is it responding to? The Singapore trader closed his laptop. He had seen enough manipulated markets in his career to recognize the pattern, but this felt different. The timing, the scale, the brazenness. Someone was not just managing the price. Someone was trying to break it completely, before something bigger arrived. In Caracas, officials at the Banco Central de Venezuela reviewed their acquisition schedule. They had been buying quietly for 18 months, paying premiums, accepting delays, building reserves, and now, with prices crashing on paper, and while physical metal grew scarce, they accelerated purchases. They understood what the market had not yet realized. This was not a liquidation. This was a transfer. Wealth moving from those who believed the screen to those who controlled the vaults. The question was no longer whether manipulation existed. The evidence was mathematical, undeniable. The question was, who benefits from the lie, and what happens when the physical world finally overrides the paper fiction? That answer required looking deeper, into the architecture of control itself. In a glass tower overlooking the Thames, 3 floors beneath street level, and where sunlight never reaches. A trading desk operates in permanent artificial twilight. The screens glow blue and green, monitoring silver positions across 12 time zones: New York, London, Shanghai, Singapore. The traders here do not buy metal. They do not sell physical bars. They trade something far more valuable. They trade perception. This is how modern market control actually works. Not through conspiracy and dark rooms, but through legal structures, regulatory gaps, and algorithmic precision. The banks operating these desks learned something critical decades ago. You do not need to own the commodity to control its price. You only need to control the mechanism, where price is discovered. And in silver markets, that mechanism is fatally flawed. Consider the mathematics. The COMEX exchange, where silver futures trade globally, holds approximately 300 million ounces in registered vaults. Metal available for actual delivery to contract holders. But the open interest, the total contracts outstanding, represents over 900 million ounces, 3 times more paper claims than physical metal exists. This is not banking. This is a betting parlor. And the house always wins. The technique has a name in trading circles: spoofing. It works with surgical precision. A trader places massive sell orders, thousands of contracts. These orders appear in the market depth, visible to all participants, creating the illusion of overwhelming supply. Other traders see this wall of selling and panic. They sell too, front-running what appears to be inevitable decline. Then, milliseconds before execution, the original orders vanish, canceled. The bank never intended to sell. They intended to create fear. In 2019, a JP Morgan trader was sentenced to prison for this exact practice. In 2020, Morgan Stanley paid fines. In 2021, Bank of America settled similar charges. The legal precedent is established, documented, public record, and yet the practice continues because the fines are far smaller than the profits. On January 3, 2026, the pattern repeated with textbook clarity. At 2:47 a.m. Eastern Time, when New York traders were asleep, when Asian markets had closed for the New Year holiday, when liquidity was at its weekly minimum, 47,000 contracts hit the market. The timing was not coincidental. It was calculated. Professional algorithms scanned for these exact conditions: low volume, thin order books, maximum impact. The price crashed $4 in minutes, triggering stop losses across retail platforms globally. Thousands of small traders forced to sell, while institutional desks bought the bottom. But here is what separates this episode from previous manipulations. The context has changed. In past cycles, banks manipulated prices to generate trading profits. This time, they are manipulating to survive. Basel III regulations, implemented across global banking, require physical metal backing for precious metal positions. No more naked shorts. No more paper promises without collateral. The deadline approaches, June 2026, 5 months away. The banks holding massive short positions face a binary choice: deliver physical metal they do not have, or close positions at whatever price the market demands. Except, there's a third option: crash the price, shake out retail holders, buy back contracts at distressed levels. Before the physical shortage becomes undeniable, this is not theory. The inventory data confirms the strategy. COMEX registered silver fell by 42 million ounces in December alone. While open interest barely changed, someone is draining the vaults while maintaining paper positions. In the London bullion market, a parallel dynamic unfolds. The LBMA clears over 150 million ounces monthly, but their published vault holdings are dropping. From 800 million ounces in 2023 to just over 600 million today. Where did 200 million ounces go? The official answer is industrial consumption and investment demand. But the timing suggests something different. Major sovereign buyers, who do not report their acquisitions publicly, are quietly accumulating at suppressed prices. Venezuela's central bank is documented, but they are not alone. Intelligence from Swiss refineries indicates accelerated orders from Middle Eastern buyers, Asian sovereign wealth funds increasing allocations, even certain European central banks diversifying reserves, all buying physical, while paper prices crash. This creates the perfect paradox. The more the banks suppress the price, the more attractive physical metal becomes to strategic buyers. The more physical is removed from the market, the harder it becomes for banks to close their short positions. It is a trap of their own design. And the spring is tightening. The question serious analysts now confront is not whether manipulation exists. The question is, how long can it continue before the physical world overrides the paper illusion, before someone demands delivery that cannot be met, before the entire mechanism breaks. And when it breaks, the price will not rise gradually. It will gap violently, irreversibly, leaving those holding paper promises, facing counterparties who cannot deliver. This is why Venezuela accelerates purchases now, why China banned exports now, why informed buyers ignore the screen price and focus on vault inventories. They see what the average investor cannot. The endgame approaching, where physical scarcity finally trumps paper abundance. But understanding the mechanism is only half the picture. The other half requires examining who is buying and what they know that the market does not. In the vault of the Banco Central de Venezuela, beneath 17 feet of reinforced concrete, a different kind of revolution is unfolding. Not with speeches, not with protests, but with metal. Every month since July 2024, armored trucks have arrived at undisclosed locations, carrying sealed containers marked only with weight and purity stamps. No fanfare, no press releases, no public announcements, just steady, relentless accumulation. By December 2025, Venezuela had quietly assembled over 80 million ounces of physical silver, more than the entire strategic reserve of most developed nations, and they were not slowing down. The question that puzzled Western analysts was simple: why silver? Why now? And why Venezuela? A nation struggling with currency collapse, choosing to allocate precious foreign exchange, not to food imports, not to infrastructure, but to a metal most investors barely understand. The answer becomes clear when you stop thinking like a trader and start thinking like a sovereign. Venezuela's economy operates in a perpetual state of monetary emergency. The bolivar loses value by the hour. Inflation renders cash worthless before citizens can spend it. Dollar reserves are subject to sanctions and seizure. Gold, too visible, too tracked, too politicized. But silver moves quietly. In August 2024, a senior official at Venezuela's central bank gave a rare interview to a regional economic journal. His words were precise. "We are not investing. We are preserving purchasing power across generations. Silver is the insurance policy the West forgot it needed." He did not elaborate, but his meaning was unmistakable. Venezuela was not speculating on price appreciation. They were escaping the dollar system entirely, and they were not alone. 3,000 miles northwest, in Beijing, a different calculation was producing the same conclusion. On January 1st, 2026, China's Ministry of Commerce announced export restrictions: antimony, gallium, germanium, and now silver. The official justification was national security, protection of strategic resources for domestic industry, but industry insiders knew the real reason. China was not restricting exports to protect supply. They were restricting exports because they were importing. The data told a story Beijing preferred to keep quiet. In 2023, China exported 112 million ounces of refined silver. In 2024, exports dropped to 78 million. In 2025, just 41 million. While domestic mine production remained constant, the missing metal was not disappearing. It was being stockpiled. The State Administration of Foreign Exchange, China's reserve manager, had been quietly instructed to diversify holdings away from U.S. treasuries toward hard assets. Gold was obvious, platinum too small, palladium too volatile. But silver had unique characteristics: industrial, monetary, strategic, undervalued, and most importantly, available in quantity at suppressed prices. By late 2025, estimates suggested China had accumulated over 400 million ounces through state-owned enterprises, provincial governments, and sovereign wealth vehicles, none of it reported, all of it deliberate. A geopolitical analyst in Singapore, who specialized in commodity flows, noticed something peculiar in the shipping data. Silver refined in Australia, officially destined for European buyers, was being diverted mid-transit to Shanghai. Contracts were being reassigned, payments rerouted. The metal never reached its original destination. When he cross-referenced this with Swiss export statistics, the pattern became undeniable. Refined silver leaving Switzerland for London vaults was being re-exported to Hong Kong within weeks, then disappearing into mainland China. The physical metal was migrating east, while Western exchanges showed ample supply on paper. This was not new behavior for China. In 2010, they controlled 3% of global rare earth production, then methodically restricted exports, while stockpiling domestically. By 2015, they controlled 97% of supply and dictated terms to every technology manufacturer globally. The playbook was identical, just a different metal. But China and Venezuela were not the only players. In Moscow, Russia's central bank had been accumulating since 2022. In Riyadh, the Saudi Public Investment Fund added silver to strategic portfolios. In Mumbai, the Reserve Bank of India quietly authorized increased holdings. Even certain European institutions, legally prohibited from public disclosure, were building positions through intermediary structures. A pattern was emerging. Nations preparing for monetary system transition were accumulating the one asset Western institutions were desperately trying to suppress. The irony was mathematical. Every time the banks smashed the paper price, they made physical metal cheaper for sovereign buyers, who were not trading, but removing supply permanently. In Geneva, a private bullion dealer who supplied central banks and sovereign wealth funds described the situation in blunt terms. The West is selling paper at $26. The East is buying metal at $29. The spread is the transfer fee. From empire to empire. His waiting list for physical delivery had grown to 11 weeks. His vault inventory had never been lower, and his sovereign clients were placing orders faster than refineries could produce. This created a situation unprecedented in commodity markets. A price crash in the futures market, coinciding with a physical shortage in the spot market. It was the financial equivalent of watching thermometers drop while the building burns. The question was no longer whether manipulation existed, or even who was manipulating. The question was, what do the sovereign buyers see that the paper market does not? Why are nations accumulating when prices are falling? What timeline are they preparing for that the average investor cannot yet perceive? The answer to that question would determine who survives the transition and who gets left holding worthless paper when the vaults finally run dry. In Basel, Switzerland, the Bank for International Settlements occupies a building that most people pass without noticing. No protesters gather outside, no headlines mention its deliberations, yet every decision made within those walls ripples through the global financial system. In November 2025, a closed-door meeting convened, representatives from 43 central banks discussing a problem that officially does not exist. The fractional reserve structure of precious metals markets was approaching critical instability. The minutes from that meeting will remain classified for 30 years, but 3 participants, speaking separately to trusted contacts, described the same concern. If a single major institution demands physical delivery and cannot be satisfied, the entire pricing mechanism collapses. Not gradually, not with warning, but instantly. This is not speculation. History provides the template. In March 2022, the London Metal Exchange faced exactly this scenario. Nickel prices exploded from $29,000 per ton to over $100,000 in less than 24 hours. Why? Because a Chinese producer demanded physical delivery, and the exchange could not provide it. Trading was halted, contracts were canceled retroactively. Buyers who had purchased at $50,000 saw those trades erased. The entire market structure was rewritten to protect institutions at the expense of market integrity. Silver faces the same structural vulnerability, but on a vastly larger scale. The COMEX holds 300 million ounces in registered vaults. Open interest represents 900 million ounces in claims. If just 10% of contract holders demand delivery, the system cannot fulfill those requests. And now, with Basel III regulations requiring physical backing, with China's export ban eliminating new supply, with Venezuela and other sovereigns removing metal permanently, the mathematics are becoming impossible. A risk analyst at a London-based macro fund ran a stress test simulation in December 2025. His model examined what happens when registered inventory falls below 200 million ounces. While open interest remains above 600 million, the ratio crosses a threshold where confidence breaks. In his simulation, the breaking point arrived when delivery requests exceeded available inventory by 40%. At that moment, the exchange faced 3 options: force cash settlement, violating contract terms, halt trading, destroying market credibility, or allow prices to gap upward until physical supply returned. Every option resulted in systemic disruption. His report was circulated privately among institutional clients. The conclusion was stark. Silver markets are currently operating beyond structural capacity. The question is not if, but when reconciliation occurs. For manufacturing executives, this creates immediate operational challenges. Solar panel production requires 65 million ounces annually. Electronics manufacturing, another 90 million. 5G infrastructure build-out, projected 30 million more. If physical supply becomes constrained, production lines halt, regardless of paper market prices. A procurement officer at a German automotive supplier described receiving force majeure notices from 3 silver suppliers. Contracts signed in 2024 at fixed prices were being declared unenforceable due to supply disruption. His company now faced spot market purchasing at prices 30% above budget, with delivery timelines that jeopardized production schedules. This is the real economy consequence of paper market manipulation meeting physical reality. For investors, the implications are equally profound. Traditional portfolio theory assumes price discovery reflects supply and demand, but when price discovery is compromised, standard risk models become dangerously misleading. A pension fund manager allocating to commodities might see silver as overvalued at $26 based on futures pricing and technical analysis, while missing entirely the physical metal trades at a 23% premium and is unavailable at any price, with delivery under 8 weeks. The disconnect creates asymmetric opportunity for those who understand it. Strategic buyers are implementing a framework that separates speculation from positioning. They monitor 4 indicators, not price charts. First, registered COMEX inventory levels. When this falls below 250 million ounces, urgency increases. Second, delivery times from primary dealers. When this extends beyond 6 weeks, scarcity is real. Third, physical premiums over spot price. When this exceeds 15%, paper markets are losing credibility. Fourth, sovereign accumulation patterns. When central banks buy, regardless of price, systemic transition is underway. As of January 2026, all 4 indicators are flashing red. Registered inventory sits at 287 million ounces and falling. Delivery times average 9 weeks from reputable dealers. Physical premiums range from 17 to 24%, depending on form. And sovereign buying has accelerated, not slowed, during the price crash. For entrepreneurs, this environment presents unique opportunities. Physical distribution infrastructure is underdeveloped. Secure storage solutions are limited. Authentication and verification services are fragmented. The gap between paper markets and physical delivery creates demand for intermediaries who can bridge that gap reliably. But opportunity comes with risk. When systemic transitions occur, liquidity vanishes first. Those holding paper contracts may find counterparties unable to perform. Those holding physical metal may find buyers willing to pay, but unable to access. Navigation requires not just capital, but operational capability. The timeline for resolution remains uncertain. Basel III compliance deadlines suggest June 2026 as a critical juncture. China's export ban creates immediate supply constraints. Venezuela's accumulation removes another 60 million ounces from circulation annually. Industrial demand growth adds pressure quarterly. The variables compound, but central banks cannot predict when confidence breaks. What is certain is this: the current structure cannot persist indefinitely. Paper claims will eventually reconcile with physical reality, and when that reconciliation occurs, it will not be gradual or orderly or fair. It will favor those who prepared, those who understood that price on a screen is not the same as metal in a vault, those who recognized that sovereign nations buying while institutions manipulate is not a contradiction, it is a signal. The business community faces a choice: continue trusting price discovery mechanisms that no longer function, or develop independent analytical frameworks based on physical flows. The difference between these approaches will determine who navigates the transition and who becomes collateral damage. The vaults are draining. The sovereigns are accumulating. The banks are trapped in positions they cannot close, and the clock is running. What happens next is no longer a question of if, only when, and whether you saw it coming. In time to act. The data does not lie. The vaults are emptying while the paper market pretends abundance. This is not a prediction. It is a measurement. The question before you now is not what will happen, but what you will do with this information. If this analysis changed how you see silver markets, consider sharing it with someone who needs to understand what the financial media will not tell them. And if you found value here at Currency Insights, we would appreciate your subscription, not for our benefit, but because the next systemic shift may arrive faster than you expect. And preparation requires information that most will never receive. Thank you for your time, your attention, and your trust. Until the next analysis, stay informed, stay strategic, and remember, in markets built on paper, physical reality always wins eventually.